Welcome back to the Deep Dive. It is Monday, February 2nd, 2026. And frankly, looking at the charts this morning, the vibe out there is, it's heavy.
It is definitely heavy.
We're staring at Bitcoin, trading around $77,522. Now, I have to laugh a little bit because if I had told you that number 3 years ago, you would have been popping champagne and, planning your retirement.
Oh, absolutely. But context is everything.
Context is everything.
It's the only thing that matters because we are coming down from that massive sugar high of January where we punched through $126,000?
Or 126K, yeah.
So naturally, waking up to a 38% drawdown feels less like a correction and more like a financial hangover.
A severe hangover. And that's really the mission for today. We need to figure out if this is just a headache that goes away or if we are looking at something more serious in the market.
A real illness.
Yeah. We've got a massive stack of sources to get through financial news on a very loud NASDAQ listing involving the Trump family, the fallout from the Genius Act.
Which is huge.
Some confusing sentiment reports from Kraken and Milk Road, and ETF flow data from ETF Action that honestly seems to contradict itself.
It really does look contradictory on the surface. You have all this institutional plumbing being built at just a rapid pace, but the price action is screaming sell.
Right, and that's the tension I want to explore. Are we looking at a crash, or are we witnessing the final transition of crypto from the Wild West into the, the boring, predictable corporate boardroom?
I think boring is the key word for 2026. If you zoom out, this year isn't about the hype cycle. It's about regulatory clarity and infrastructure. The price is cooling, but the foundation is curing.
Let's test that theory with the biggest headline of the week. Yeah. We have a new player on the NASDAQ, officially listed under the ticker ABTC. The company is American Bitcoin.
Not a subtle name.
Not subtle at all. It sounds less like a company and more like a super PAC.
It certainly has a brand identity. American Bitcoin is the result of a merger finalized this week with Griffin Digital Mining. And you are right to flag the branding because the names on the cap table are just as loud. This isn't some silent takeover.
No, it's remarkably loud. The ownership structure here is fascinating. 98% of the new entity is owned by existing shareholders. You've got the crypto miner Hut 8 involved, but the headliners are, of course, Donald Trump Jr. and Eric Trump.
And Eric Trump is the chief strategy officer.
Right. Their stated vision is to create the most investable Bitcoin accumulation platform. Now, pause there. That sounds like corporate buzzword salad.
It does.
Investable accumulation platform. Isn't that just a fancy way of saying we mine coins and we keep them?
On a technical level, yes. But you have to look at the why. Why merge with Griffin? Why now? The investable part, I think, comes from the operational efficiency. Griffin was a strategic target because of their specific focus on green mining, hydro, wind, solar.
Okay, I have to play devil's advocate here. Usually when I hear green mining coupled with a political family that hasn't, historically prioritized ESG scores, it feels a bit like a PR shield. Is this actually about the environment, or is there a hard economic reason for this?
It is almost entirely economic. The PR is a nice bonus, but in Bitcoin mining, your operating expenses, your OTEX, is something like 70% to 80% just electricity.
Wow, that high.
Oh, yeah. So if you are relying on the standard grid, you are subject to price surges, geopolitical energy crises, all of it. If you lock in renewable strategies, especially hydro, which is very consistent, you are effectively hedging your biggest cost.
So it's not about saving the polar bears. It's about defending the margin.
Exactly. When Bitcoin drops to $77,000 like it is today, the miners with high energy costs start turning off their machines because they are literally losing money on every coin.
But not them.
Right. A company like American Bitcoin, using Griffin's low-cost renewable infrastructure, can stay profitable much, much longer. It's a survival play.
Okay, that makes sense on the balance sheet. But we can't ignore the political signal here. We are seeing former President Trump actively positioning the U.S. as a global leader in crypto, and now his family is running a NASDAQ-listed mining operation. This feels like a massive blurring of lines.
Well, looking at it impartially, just through the lens of market analysis, it's a signal of permissiveness. The sources note Trump's commitment to a lenient regulatory approach.
Right.
So for an investor, seeing the Trump family holding equity in a U.S. miner, it signals that the threat of a government ban, which was a real fear back in 2021 or 2022, is effectively zero. The political headwinds are becoming tailwinds.
And the market bought that narrative immediately. The sources mentioned Griffin shares saw a threefold increase in pre-market trading just on the announcement.
That's the legitimacy premium in action. It is. It sends a message to Wall Street. This asset class is now safe for the establishment. It's no longer an offshore game. It's a NASDAQ game.
Speaking of making things safe for the establishment, let's pivot from the miners who make the coins to the suits who want to hold them. We need to talk about the legislative landscape because 2026 feels very different. The Genius Act.
The Genius Act, yeah. It was passed in 2025, but we're really feeling the implementation now.
I remember reading about this when it was being debated, and it felt like just another layer of bureaucracy. But looking at the source material now, it seems like it was actually the key to unlocking corporate treasuries.
It was the missing piece of the puzzle. The act created a licensing regime for permitted stablecoins.
Right, but let's not get bogged down in definitions. We know stablecoins are basically digital dollars. Why does a licensing regime change anything for a company like, I don't know, Apple or Google? Why couldn't they just use them before?
It's all about liability and accounting. Before the Genius Act, if a CFO put $1 billion into a stablecoin to move money across borders faster, they were taking a huge regulatory risk. Was it a security? A commodity? Would the issuer just vanish? The Genius Act treats these permitted stablecoins as tokenized cash equivalents subject to supervision. It's basically a banking charter for crypto.
So it turns a gray area asset into a cash equivalent.
Correct. And that means companies can legally hold them in their treasuries without having to explain it to the SEC every single quarter. It integrates crypto rails into the actual banking system. It's boring, but it's the kind of boring that allows trillions of dollars to move.
Boring but allows trillions to move seems to be the theme here. And that brings us to the next logical step. If companies are getting comfortable holding digital assets, what about governments?
The states.
The strategic Bitcoin reserve narrative. It's been bubbling for a while, but now we have actual movement. Texas.
Texas is the headline, yeah. They became the first U.S. state to execute a purchase of Bitcoin for their state treasury.
Okay, but look at the number. The sources say they bought $5 million worth of BlackRock's spot Bitcoin ETF. $5 million. For an economy the size of Texas, that is. It's nothing. It's a rounding error.
Oh, for sure.
Is this actually a strategic reserve, or is it just a political stunt to get headlines?
It is definitely a toe-in-the-water situation. You're right, $5 million doesn't move the needle on the Texas budget. But in the world of sovereign wealth, precedent is everything.
Oh.
It's a pilot program. It validates the legal mechanism of a state holding Bitcoin right alongside its gold and its municipal bonds.
So it's a proof of concept.
Precisely. And they aren't the only ones looking at it. The sources highlight that there are 19 strategic Bitcoin reserve bills, SBR bills, currently live across 8 different states.
8 states.
Yeah.
Including Arizona and New Hampshire.
Right. Now, to be fair, the sources also note that many states voted against these measures.
Right, so it's not a unanimous wave, it's a battleground.
It is. But the fact that state legislatures are even debating how much Bitcoin should we hold rather than should we ban Bitcoin, I mean, that just shows how much the Overton window has shifted.
This is where I want to bring in the comparison to gold, because I feel like this is the moment where that comparison really starts to matter. The sources included data from Pocketful comparing asset caps. If Texas is starting to treat Bitcoin like gold, a reserve asset, how do those two markets actually stack up?
The gap is still enormous, and this is really important for you to grasp. Gold is the #1 asset in the world by market cap, sitting at roughly $32.04 trillion.
32 trillion.
And Bitcoin, even after the big run-up to the all-time high, is sitting around $1.84 trillion. It's, what, the #8 asset in the world?
So gold is still more than 15 times bigger than Bitcoin?
Exactly. So when we talk about Bitcoin acts like digital gold, we have to be realistic. For Bitcoin to actually flip gold or even reach half of gold's market cap, the price per coin would have to be, well, astronomical compared to where we are now.
Which implies that despite this crash, despite the feeling that we missed the boat at 126K, we are still arguably very early if you believe that digital gold thesis holds water.
If you believe that thesis, then yes, the upside is still mathematically massive. That brings us right back to the immediate problem.
Yeah.
If the long-term thesis is so strong, if Texas is buying, if Trump is mining, if the Genius Act is passed, why is the price tanking?
That is the conflict. This is the part that confuses me. We have all this good news regarding adoption, but the ETF action data for February 1st is just brutal.
It is ugly.
While the broader market, like iShares, saw $2.5 billion in inflows, the Bitcoin spot ETF saw a retreat A big one.
Yeah.
We saw outflows of $641 million in a single day.
A single day.
So how do you reconcile that? How can Texas be buying while the ETFs are dumping?
You have to separate the tourists from the locals. The ETF flows, they largely represent the tourists, institutional allocators, hedge funds, and retail investors who bought the momentum.
Right.
They saw the price hit 126K, they saw it start to slip, and they are de-risking. They are taking profits or they're cutting their losses.
So they are renting the asset, not owning the philosophy.
Exactly. And $641 million leaving in a day creates massive sell pressure. That's what drives the price down to 77Kers. But the locals, the entities like American Bitcoin, like the state of Texas, like MicroStrategy holding 650,000 BTC, they aren't selling.
They're accumulating.
They are accumulating because the price is down.
So we are witnessing a handoff. The weak hands are folding because of the volatility, and the strong hands, the strategic reserves, are stepping in to try and set a floor.
That's a theory, and the Caleb and Brown analysis in our sources supports this. They call this phase 4 crash correction.
It's a cooling phase.
Right. Historically, after a bubble pop, Bitcoin would draw down 80%. I mean, we'd be looking at $25,000 right now.
Oh.
But we are holding at $77,000. That is a 38% drop. That suggests the floor is much higher than it used to be because the strategic buyers are stepping in earlier.
It's a higher floor, but it still feels terrible if you bought the top.
Let's look at the sentiment, because the Milk Road Crypto Fear and Greed Index is painting a pretty grim picture. Yeah, we are firmly in fear or even extreme fear territory. The score is hovering somewhere between 0 and 46.
And this is the irony I can't get over. We are at $77,000. 3 years ago, $77,000 would have been extreme greed. It would have been euphoria. Now it's fear.
It's just recency bias.
It really shows how our brains are just wired to only care about the last 30 days.
It is. But this index is useful because it measures momentum, not value. And historically, the best time to enter the market is when that index is flashing extreme fear. But, and this is a huge...
Can't on the bottom.
You're still catching a falling knife. It's dangerous. Just because people are scared doesn't mean the price can't go to $60,000 tomorrow.
Right. Fear isn't a buy signal. It's just a mood ring. So looking forward, if we survive this cooling period, what does the rest of 2026 look like? Because despite the gloom, the sources have some surprisingly bullish predictions.
Standard Chartered is one of the more vocal bulls here. They aren't backing down. Their forecast suggests that if the macro liquidity situation stabilizes, meaning if the Fed keeps rates steady or maybe even cuts them.
A big if.
A huge if. But if that happens, Bitcoin could target $175,000 to $250,000 by the end of 2026.
That feels like a million miles away from where we are sitting today.
It does, but you have to remember how quickly we moved from 40K to 120K. Crypto reprices violently. But I think the more sustainable trend for 2026 isn't the price target. It's what the World Economic Forum and BlackRock are focusing on.
Tokenization.
Tokenization.
We hear this buzzword a lot, real-world assets. But let's make it concrete. Why does tokenization matter to anyone who isn't a tech nerd?
It matters because of liquidity. Larry Fink at BlackRock calls it the expansion of investable assets. Right now, if you want to sell a commercial building, it takes months.
Right.
If you want to sell a bond, it can be slow, depending on the market. If you tokenize those assets, put them on a blockchain, you can trade them instantly, 24/7, just like you trade Bitcoin.
So it turns slow, clunky assets into fast, liquid assets.
Exactly. And the line between TradFi, traditional finance, and DeFi, decentralized finance, is just disappearing. The sources mention JP Morgan is now issuing a USD deposit token on a public blockchain.
That's a big deal. JP Morgan isn't exactly a crypto-anarchist collective.
No, they are the establishment. And when they start using public blockchains for deposit tokens, it kind of proves that the technology has won. The casino aspect of crypto might be crashing right now, but the back end of the financial system aspect is being built as we speak.
It seems like we are entering an era where crypto becomes invisible.
Yeah.
It's just the plumbing that makes the money move.
That is the ultimate goal. You don't think about TCP/IP when you send an email. Soon, you won't think about blockchain when you move money. It will just be how money works.
So let's try to pull all these threads together. We have a price crash that hurts. We have ETF investors fleeing the scene. But simultaneously, we have the Trump family building a mining empire on the NASDAQ.
Right.
We have Texas testing the waters with a strategic reserve. And we have the banking laws rewriting themselves to accommodate this tech.
It's the classic divergence between price and fundamentals. The price is volatile, it's emotional, and it's currently depressed. The fundamentals, the adoption, the infrastructure, the legal frameworks, they are stronger than they have ever been in history.
It feels like the teenage years of Bitcoin are over. The wild parties are done. And now it's getting a job, buying a suit, and going to work from 9 to 5.
And getting a job is boring. But getting a job is how you build a future. We are witnessing the boringification of the asset class.
So here's the final thought I want to leave you with today. We spend our days refreshing the charts, obsessing over whether Bitcoin is at 77K or 80 techs. We panic when the fear and greed index turns red. But look at what is happening around us.
The real story.
American Bitcoin is on the NASDAQ. Texas is buying. JP Morgan is building on-chain. Are we mourning the end of the get-rich-quick volatility while failing to celebrate the beginning of the stay-rich-forever stability?
It's a great question. If Bitcoin becomes a standard treasury asset, if it becomes boring, does that kill the excitement that brought all of us here in the first place? Or is boring exactly what winning looks like?
I have a feeling that in 10 years, we'll look back at the boring year of 2026 as the year it all actually started to matter.
I wouldn't bet against that.
Thank you for listening to this deep dive. Don't let the red charts ruin your week. Zoom out, look at the plumbing, and stay curious. We'll catch you on the next one.